Today, that misguided approach is catching up with us quickly. Lower and middle income Americans are struggling to afford groceries, housing, and other essentials. The Fed's quote-unquote Band-Aid policies like monetizing federal debt and manipulating interest rates have only papered over deeper problems while driving up the cost of living. Hello, welcome to this week's economy. I'm your host, Dr. Vance Ginn. Thank you for joining me again today. Always a pleasure to have you here. The last couple of weeks has been busy for me. I've been out of town in Kansas City, Missouri, to the Missouri Valley Economic Association meetings. Had a great conference there. I was elected president-elect of that association, and so I will be president going into the following year. And so I'm looking forward to that a lot. I've been going to this conference since 2007, so nearly 20 years. Actually, the meeting that I'll be president of in October or early November of 2027 will be my 20th year. So it's quite fascinating. A lot of great people there. If you're listening to this and you want a good conference to go to, that's not too big, but also not too small, that you can get some good feedback on your research and have a good time, you should check out the Missouri Valley Economic Association. Great place overall. In 2026, it'll be in Omaha, Nebraska. And then we'll see where it's going to be at in 2027. But check that out. And then I also have been at SMU at the Bridwell Institute for Global Markets and Freedom with Bob Lawson and a whole bunch of other great folks for their Economic Freedom of North America conference that they do, along with the Fraser Institute. So that report will be coming out soon, and it's always good to see folks up in Dallas for that meeting. So it was great to see you if I saw you there. Still got a lot of other stuff going on, so let me go ahead and get into what I have prepared for you today. All right, so last week, the Federal Reserve cut interest rates by 1/4 percentage point, which is 25 basis points, down from 4.24 to 4.25%, down to 3.7 to 4%, right in that range. I'm recording this, I should mention, before this has been released because I will be out of town up in Dallas whenever this is done. So for some reason, if they did not cut it by 25 basis points, then that's the reason. But my guess is, given what I'm hearing a lot from the Fed, from the markets and everything else, is that they will cut by 25 basis points. This will mark the second of what some expect to be a series of rate reductions in the coming months. The move came after new data showed consumer inflation rose 3% year over year, slightly less than expected, but above the Fed's 2% inflation target. Traders are already betting on more cuts ahead. But the real question isn't whether lower rates will boost the economy in the short run or not. It's whether the Fed has learned from its mistakes or is setting up as yet for another boom and bust cycles like they're so good at doing. In this episode of This Week's Economy, we're going to break down the Fed's decision, what it means, why it matters, and what real reform should look like if we want lasting prosperity. You can catch the full episode on YouTube, Apple Podcast, or Spotify, and visit my website at vanceginn.com for more information. Remember, the Let People Prosper show is a listener and a reader supported publication where you can find my show notes at vanceginn.substack.com. To receive new posts and support my work, become a subscriber today. I also take tips. No tax on tips. Why not allow that to come in as well? So reach out to me if you would like to do that. So, how did we get here with this fiscal and really monetary situation when we're thinking about the Federal Reserve? Well, the Federal Reserve was created in 1913 under President Woodrow Wilson. And this came after the 1907 banking crisis and then an Aldrich Commission that was put together to come up with a way to backstop some of the banks during these boom and bust, not necessarily boom and bust cycles, but downturns in the banking sector. And the big push was for another central bank. This would have been our third. Remember, the first central bank by Hamilton was closed, and the second central bank closed by Andrew Jackson was also the time when they balanced they actually paid off all the debt during the 1830s as well. That would be nice. But we've had the Federal Reserve, our central bank in the United States now since 1913. So it's been quite a while. And so we need to figure out, okay, how is this doing? It's been around for more than a century. And what it helped to do was to stabilize the economy, to prevent financial panics, control inflation, and keep powerful financiers from manipulating markets at the expense of working Americans. For much of its early history, the Fed's role was relatively limited to being a lender of last resort. That changed over time, especially when you saw what happened during the late 1920s, when you had a large amount of money creation contribute to the stock market bubble and other bubbles throughout the economy that then contributed to the collapse, which contributed to what we saw as the Great Depression, which you also got to throw in the Smoot-Hawley tariff acts, the boom and bust cycles and tax hikes and increase in subsidies by the Hoover administration. And then, of course, FDR made that much worse. But we also saw some bad decisions that were made over time by the Federal Reserve, by the central bank in the 1970s and 80s, whenever you saw really the great inflation of the 1970s. And then in the 1980s, you had really it was right at the end, 1979, I believe it was, when Paul Volcker came in, who happened to be Jimmy Carter's nominee for the Fed. This wasn't a Reagan nominee. This was a Carter nominee, if you could believe it. But you remember, he jacked up interest rates really high. He brought down money supply and everything else. And then that is what broke the back of inflation during that time. It helped that you had the pro-growth tax cuts during the Reagan years and everything else. But it was really a lot to do with what the Fed had done. So when inflation spirals out of control, like what Paul Volcker did, he took bold action. He raised interest rates, tightened the money supply. It did cause a short-term pain with a double-dip recession during the early 80s, but ultimately broke the back of inflation and helped usher in prosperity during the Reagan years. But over time, the Fed has drifted far from those principles where it started. Instead of maintaining stable prices and sound money, it's fueled massive growth in the money supply by ballooning its balance sheet to unprecedented levels, undermining the value of the dollar in the process and wrecking the economy. Today, that misguided approach is catching up with us quickly. Lower and middle income Americans are struggling to afford groceries, housing, and other essentials. The Fed's quote-unquote Band-Aid policies like monetizing federal debt and manipulating interest rates have only papered over deeper problems while driving up the cost of living. The good news here, though, there is an opportunity ahead. The Trump administration and Congress can chart a new course, one that restores sound monetary policy and sets America on a sustainable path to let people prosper. So let's now look at the policy changes needed to restore sound money and let people prosper. Number one, understanding the Fed's job. The Federal Reserve manages what's known as high-powered money, the base of our financial system, through the assets on its balance sheet. These now include U.S. Treasury securities, mortgage-backed securities, and loans to financial institutions, and even agency debt within government. Every move it makes influences how much money circulates throughout the economy and the price of money and credit. The role of the central bank here is that the U.S. dollar remains the global reserve currency. Its strength depends on confidence. We're confident in both fiscal discipline from Congress and monetary discipline from the Fed. Both have faltered. Reckless spending and easy money have weakened the dollar, driven inflation up, and risked shifting global economic power away from America. The Fed's main mission, which is a dual mandate set by Congress, is to maintain price stability and maximum employment. Well, during the pandemic, it violated the first mandate by flooding the economy with cheap money and trillions of dollars in asset purchases, fueling inflation. And it went up to about 9%. Now, in overcorrecting the rapid rate hikes and quantitative tightening, it's violating the second, slowing growth and opportunity. This constant pendulum swing between stimulus and tightening creates the boom and bust cycle that hurts families and small businesses most. It also creates the economic anxiety that we have across the country, where you have so much uncertainty what prices are going to be. Of course, that is exacerbated by the President Trump's policies of excessive spending, of increases in tariffs and taxing hikes on tariffs. And those sort of things slow down the economy and create worse confidence in the economy. I explain more about the Fed's role in global confidence in the dollar in my piece with Chuck Beecham at the Daily Caller, which you can check out at the show notes page. Number two here, how the Fed controls the money supply and fuels inflation. The Fed controls the money supply through its balance sheet and interest rate policies. When it buys Treasury debt or other assets, it injects high-powered money into the banking system. But this money doesn't reach everyone equally or immediately. It flows first through the financial sector, banks, investors, and asset markets before reaching the broader economy, Main Street, if you will. Economists call this the Cantillon effect, where it really allows for these different levels of money circulation throughout the economy instead of a helicopter drop type of approach. Milton Friedman, who extensively studied the Fed and the roles of it in economic activity and inflation, said, inflation, this is a quote, inflation is always and everywhere a monetary phenomenon. It is a result of a greater increase in the quantity of money than the output of goods and services which is available for spending. That uneven flow of new money distorts prices and production. Certain industries boom first, pulling in resources and labor, only to bust later when the flow of easy money stops. The Austrian business cycle theory explains this clearly. Artificial credit expansions cause artificial growth and painful contractions. There's a shared responsibility here, though. Congress plays a major role. Out of control, federal spending feeds the Fed's appetite for treasury debt, expanding the money supply and driving up inflation. Fiscal and monetary recklessness are two sides of the same coin. To restore stability, Congress must adopt a fiscal rule that reins in deficits and spending, while the Fed returns to sound money principles. Together, that's how we let endless inflation and we can let people prosper. You can read more about the dynamic between Congress and the Fed in my column at the Daily Economy, which you can also find out the show notes page. Number 3, reducing a bloated balance sheet. The Fed's balance sheet is the backbone of its monetary policy. It lists what the Fed owns, like treasuries and mortgage-backed securities, and what it owes, such as dollars in circulation and bank reserves. Every entry has a ripple effects throughout the economy. That balance sheet exploded during the pandemic, soaring from $4 trillion in early 2020 to nearly $9 trillion by 2022. Though it's down to around $6.6 trillion today, it remains 75% higher than before the pandemic. That expansion fueled inflation by creating excess demand and blurred the Fed's proper role, turning it from a monetary referee into a market participant. What they need to do, really, and I've been saying this, but I'm going to keep saying this, is they've got to shrink the balance sheet. A $6.6 trillion balance sheet paired with runaway federal deficits and tariffs continue to drive inflation and slower economic growth. The Fed should make reducing that balance sheet its top priority. Instead of leaning in on interest rate cuts like they're doing now, the Fed should focus on removing excess liquidity from the system. Shrinking the balance sheet is the most direct, lasting way to cool inflation. And I really think we need to adopt a rules-based approach. Before the 2008 financial crisis, the Federal Reserve balance sheet equaled about 6% of GDP. Today, it's roughly 23%. A rules-based cap tied to GDP would restore discipline, transparency, and confidence in the dollar. You can read more about this where I expanded on it in a daily economy article that you'll find in the show notes page as well. Number 4, who decides what the Fed will do? The Federal Open Market Committee, the FOMC, has 7 governors and 5 rotating reserve presidents. And there are 12 presidents altogether within the Federal Reserve System, so 5 of them will cycle in on these 7 board of governors. They are the ones that set monetary policy for 330 million Americans. 12 people deciding the price of money is not a recipe for efficiency or accountability. The answer isn't finding the quote-unquote right central banker. It's recognizing that no central banker can match the knowledge dispersed across millions of borrowers, lenders, and investors setting prices through voluntary exchange. We never allow a government board to set the price of beef or Bitcoin, yet we tolerate one setting the most important price in capitalism, the interest rate. Prices communicate scarcity and risk. When the Fed suppresses them, it distorts markets. As Hayek taught, markets, not bureaucrats, are best at discovering information. The Fed has wandered far beyond its dual mandate. Its job should be simple: protecting the dollar's value and acting as a lender of last resort. Manipulated interest rates are hidden subsidies, benefiting today's borrowers at the expense of tomorrow's. Let's stop turning each FOMC meeting into a global guessing game. Publish a clear framework, stick to it, and let markets price risk. You can see my commentary in the latest personnel drama, where it's called Moran Confirmed, Cook Stays, Why the Fed's Political Theater Shows Markets Should Set rates. Number 5, steps for Congress and Trump administration. Well, what we're looking at here is if America wants a financial system that fuels growth instead of holding it back, it must return to first principles, clear rules, open competition, and limited government interference. After years of central planning at the Fed, the Trump administration and Congress have a rare opportunity to restore sound monetary policy. The Fed must substantially reduce its balance sheet, preferably selling all non-treasury debt off its balance sheet as quickly as possible. Congress must rein in deficit spending and limit the Fed's emergency powers, and the administration can push fiscal discipline and transparency through a full audit of the Fed. Together, these reforms would reduce malinvestment, promote stability, and open the door to broader structural reforms, including an eventual end to the Fed. We should end the Fed, right? The long-term benefit from this is by anchoring both fiscal and monetary policy to clear rules-based limits, Americans won't have to hope for the perfect candidate each election cycle. Proper constraints encourage responsible choices, lower interest costs, and strengthen America's position in future crises. We've got to end the Fed. The ultimate goal should be a monetary system grounded in sound money, not political manipulation. Until that day, we must hold the Fed accountable, rein in its mission creep, and it should only have one mandate of price stability. Get rid of the other one. There's no Phillips curve or trade-off between inflation and the unemployment rate. Milton Friedman debunked that many decades ago. It's time to get back to sound money and to return to its core task of the Fed doing this, protecting the dollar. You can check this out and more in my recent piece with Tom Savage, where I explained how rules-based monetary policy and spending restraint can tackle America's debt crisis at law and liberty. Remember, you can get these insights and more by downloading my full guide on correcting America's financial future through better monetary policy and financial regulations, where you can find the show notes page as well. And thanks for joining me in this episode of This Week's Economy. For more insights, visit vanceginn.com and get even a greater value with a paid subscription to my Substack newsletter at vanceginn.substack.com. That would certainly help my work, continue to bring it to you each and every day, and I think you'll find that it's valuable. I'm sending out a commentary every day on the days that I don't have, some sort of podcast episode that's going on, so you don't want to miss that. I think there'll be a lot of good information for you, your friends, and family. Share this podcast. Go give me a rating as well wherever you listen to your podcast. That will also help me with all the algorithms that they put together. But it really is a pleasure to have you join me each and every week. And until next time, God bless you and let people prosper.